Today, we're diving into one of the most influential investment books ever written, A Random Walk Down Wall Street. In this video, we'll explore the key ideas from Chapter 2. We're really getting into some fascinating history here, looking at speculative bubbles and this idea of the madness of crowds. And we'll definitely be unpacking the concept of building castles in the air.
Yeah, and understanding these past frenzies, it's just so important for anyone investing today, isn't it? The lessons about, well, human psychology and how markets behave, they really are timeless. You know, Gustave Le Bon pointed this out way back. He said that in crowds, it's often stupidity that accumulates, not common sense.
That's a sobering thought.
It is. And when markets shoot up purely on that kind of psychological support, well, financial gravity eventually takes over. Prices can stay sky high for a surprising amount of time, sure, but the fall, it can be like an earthquake. Sudden, dramatic.
So this castle in the air idea, why are we so drawn to it? Why does greed, seem to trump logic so often?
It seems baked into us, doesn't it? The castle in the air theory really helps explain it. Essentially, people stop buying for intrinsic value. They buy because they hope, or maybe they believe, someone else, a greater fool, will pay even more down the line.
So it's less about the asset, more about the next buyer.
Exactly. And you see this pattern again and again. .com bubble, other recent surges. The psychology is the same. The second your main reason for buying is predicting what someone else will pay, you're building that castle. But trying to guess when the music will stop, when to get out, well, that's incredibly risky. Very dangerous game.
Which brings us perfectly to our first big example. Tulip Mania in 17th century Holland. You picture this calm, prosperous place, right? Then a botany professor brings in these rare tulips from Turkey. But the real spark, apparently, was when someone stole some bulbs, sold them, and actually made money. That got people thinking.
And then there was this weird twist with a virus, a mosaic virus. It didn't kill the tulips, but it created these amazing patterns, these flames of color on the petals. Suddenly, these weren't just tulips, they were strange bulbs, highly sought after. Public taste just zeroed in on them. The weirder the pattern, the higher the price.
Right, so it wasn't even about a perfect flower anymore. It was about the beautiful flaw, the rarity.
Precisely, the rarity caused by the virus.
And from there, it just took off. The merchants started trying to predict trends, hoarding bulbs, expecting prices to keep climbing. And they did, skyrocketed. It got to the point where the higher the price, the smarter the investment seemed. Charles Mackay wrote about this, how everyone got involved. Noblemen, farmers, sailors, maids, even chimney sweeps. They all thought the tulip craze would last forever.
And the financial system adapted, didn't it? They came up with ways for more people to play. Early versions of call options. You could pay a small premium, maybe 15–20% of the bulb's price, for the right to buy it later at a fixed price. If the price jumped, you exercise the option, buy low, sell high. Huge potential gains from a small initial outlay.
So basically leveraging up your bet.
Exactly, which opened the door for lots more people, but of course massively increased the risk involved.
There's that crazy story about the sailor, right? Helps illustrate just how valuable these things became.
Well, yeah, the sailor, just off his ship, grabs what he thinks is an onion from a merchant's counter to eat with his herring.
An onion.
An onion. Turns out it was an Admiral Leifkinshoek tulip bulb, worth a fortune, enough to feed a ship's crew for a year, supposedly. The merchant was less than pleased, had the poor guy thrown in jail. It really shows the almost absurd value people placed on these things.
He really does. Now, I know some historians, like Peter Garber, have argued there was some logic behind it all.
That's true. Revisionists like Garber point out that rare bulbs were already expensive before the peak mania, and they didn't become completely worthless afterwards. They retained some value.
Okay, so maybe not total insanity, but still, how does that explain prices multiplying 20 times over in a single month, like January 1637, and then crashing just as fast in February? That seems like more than just market fundamentals adjusting.
I agree. It's hard to square that speed and scale with pure rationality. Eventually, prices got so high that some sensible people started selling. And once that started, panic. The snowball effect. Everyone rushed for the exits at once.
And the government couldn't stop it.
They tried. Put out statements. Tried to restore confidence. But nobody listened. Deals collapsed. People went bankrupt. Prices just kept falling until most bulbs were worth less than actual onions. Classic case of financial gravity kicking back in.
Okay, let's shift gears. Imagine this. Your broker calls, super excited. New company, amazing prospects, no sales yet, no profits.
Uh-oh. Sounds familiar.
Right. And when you ask what they actually do, he says, nobody knows. But hey, you make a ton of money. Seems like an obvious scam today, maybe. But that's pretty much the story of the South Sea Bubble in England. A classic tale of fraud and greed.
And the context in England then was, well, perfect for it. They'd had a long period of prosperity, people had savings, but not many places to invest them. Owning shares was actually quite prestigious, even a way for women to own property. So the South Sea Company pops up in 1711. Its official purpose was managing government debt, but it also fed this huge public appetite for investments, promising big profits from trade with South America.
And the insiders cashed in right away, didn't they? Buying up cheap government IOUs and swapping them for company stock at full value. Meanwhile, their actual trading efforts were, well, disastrous. Failed slave trading voyages with horrific death rates. They seemed way more focused on hype than actual business.
And you have to see this alongside what was happening in France with John Law's Mississippi Company. Law had this grand vision of using paper money to boost the economy. He built this company into a massive conglomerate. Its share price went through the roof from 100 francs to 2,000. They literally invented the word millionaire during that boom. Its value was supposedly 80 times all the gold and silver in France.
Wow. And that success in France, it sort of lit a fire under people in Britain.
Definitely. There was a kind of national rivalry. Why should France get all the action? The South Sea Company became Britain's champion, especially when news broke that the war with Spain might end, opening up trade. People had these fantasies of Mexicans eagerly trading gold for British wool. Pure optimism, totally misplaced.
So the company seized the moment.
Absolutely. In 1720, they made this incredibly bold offer to take over the entire national debt, all 31 million pounds. The public loved it. The stock price jumped from £130 to £300 almost overnight when the plan was announced. And, naturally, political supporters got rewarded. Free shares handed out, including to the king's mistress, which they could flip for instant profit.
And that just fueled the fire even more, right? More share issues.
Wave after wave. They made it easier and easier to buy in. New shares at £300, easy installments. The king bought £100,000 worth. Price hits £550. Another issue. Even easier terms, 10% down, pay the rest in a year. Price shoots to £800. You had half the House of Lords, more than half the Commons involved. The price peaks at £1,000. Unbelievable.
But even that wasn't enough to soak up all the speculative money floating around.
No way. Investors were hungry for the next big thing, so promoters jumped in, launching all sorts of new companies. These became known as bubble companies, and their business plans got more and more ridiculous. Importing Spanish donkeys, extracting sunshine from cucumbers.
Sunshine from cucumbers? Seriously?
Seriously. Making lumber from sawdust. Just wild, often fraudulent schemes, nearly 100 of them, all promising massive returns.
And people bought into it.
Hook, line, and sinker. The most famous story is the guy who launched a company for a most advantageous undertaking, but no one knows what it is. Promised huge profits. Opened the books at 9 a.m. Total chaos, people fighting to get in. He collected money from 1,000 investors in 5 hours, then just disappeared, vanished to the continent, pockets full.
Incredible. Which brings us back to that greater fool idea.
Exactly. It's crucial here. A lot of these investors weren't necessarily idiots. They didn't always believe in, cucumber sunshine. But they did believe that prices would keep going up, and they could always sell their shares to someone even more gullible, an even greater fool for a profit. In their own minds, it made perfect sense. It felt rational.
Until it didn't. Were there warning signs?
Subtle ones, like those playing cards making fun of the bubble companies. But the real trigger was internal. The South Sea Company's own directors knew the share price was totally detached from reality. So over the summer, they quietly started selling off their own shares, cashing out.
And when that got out,
boom, the price collapsed, panic set in. The government tried to step in, but it was too late. Total crash. Which is when Isaac Newton supposedly made his famous comment, "I can calculate the motion of heavenly bodies, but not the madness of people."
perfectly sums up the whole castle in the air phenomenon.
It really does. Okay, those are fascinating historical stories, but they were centuries ago. Surely things are different now. Could that kind of madness happen in, say, the 20th century?
Well, let's jump to the U.S. in the Roaring '20s. Unprecedented prosperity. Calvin Coolidge famously said, "The business of America is business." Businessmen were like heroes.
And the stock market became the place to be. Absolutely. By 1928, it was a national obsession. The gains were incredible. I mean, the market gained as much between early '28 and September '29 as it had in the entire 5 years before that. Stocks would jump 10, 15% in a day. A British journalist noted how everyone in New York, no matter what they talked about, eventually ended up talking stocks and got deadly serious about it.
And this was also an era of pretty blatant market manipulation, right? These things called pools.
Oh, completely widespread. Pools operated almost openly. Take Radio Corporation of America, RCA. A pool drove its stock up 61% in just 4 days.
How did they even manage that?
It was quite sophisticated in a crooked way. A group of traders would collude, led by a pool manager. They'd quietly buy up shares, maybe get options for more. Critically, they'd often get the stock specialist on board, the person on the exchange floor who handled the orders for that stock. That specialist had the book, they could see all the buy and sell orders, huge advantage. Then they'd start wash sales.
Wash sales.
Yeah, pool members trading shares back and forth among themselves, pushing the price up with each trade. It looked like heavy, exciting volume on the ticker tape machines across the country.
Creating a buzz, basically.
Exactly. Add in some fake tips, maybe some positive press releases, timed just right by company insiders, and the public piles in. Once enough ordinary investors bought in at the inflated prices, the pool operators would, as the saying went, pull the plug on the bathtub, quietly sell all their shares, make huge profits, and leave the public holding the bag as the price collapsed.
Wow. So it wasn't just groups. Individuals could play this game too.
For sure. Especially insiders. Look at Albert Wiggin, head of Chase Bank, a huge bank at the time. In July 1929, what does he do? He shorts his own bank's stock. Over 42,000 shares.
He bet against his own company.
He did, and he timed it perfectly. Chase stock tanked, and he personally made millions from the decline. Talk about a conflict of interest. Today, that's highly illegal for insiders, but back then, different world.
Okay, so the market peaks September 3rd, 1929. What happens next? The Babson break.
Right. September 5th. Roger Babson was this financial advisor who'd been warning about a crash for ages. People mostly laughed at him. But that afternoon, his prediction gets quoted on the ticker tape, and boom, the market dives. Big names, AT&T, Westinghouse, U.S. Steel, all dropped sharply in the last hour. His moment finally arrived.
Did that shake confidence immediately?
It definitely wobbled through September. Lots of down days, despite officials and bankers saying everything was fine. You even had Professor Irving Fisher from Yale, a respected economist, famously declaring stocks had reached a permanently high plateau. He even tried to argue prohibition was making workers more productive, justifying the prices.
Permanently high plateau. Famous last words.
Pretty much. By late October, things were getting tense. October 21st, prices fall, triggering margin calls. People who borrowed to buy stocks had to put up more cash or sell. Selling pushed prices down further, triggering more margin calls. A vicious cycle. Trading volumes surged. The ticker tapes couldn't keep up, which just added to the fear.
Leading to Black Thursday.
October 24th. Massive turnover. Almost 13 million shares. Prices just gapped down. $5, $10 drops between trades. Some stocks lost 40, 50 points an hour. President Hoover came out saying the fundamental business of the country is on a sound and prosperous basis, trying to calm nerves.
But it didn't work. Then came Black Tuesday.
October 29th, 1929, the big one. The most devastating day in NYSE history up to that point. Over 16 million shares traded. Prices just fell off a cliff, almost vertically. By the time the market finally bottomed out in 1932, it was carnage. Most blue chips down over 95%. Even AT&T, seen as safe, lost 3/4 of its value.
Just brutal.
Yeah. Variety, the showbiz paper, had that classic headline, "Wall Street lays an egg." Summed it up perfectly. Billions wiped out, millions of people ruined, and of course it ushered in the Great Depression. Again, some historians argue maybe monetary policy played a role, that there was some logic, but fundamentally those late 20s gains just weren't sustainable.
And you mentioned there's specific evidence of just how irrational things got. Something about closed-end funds.
Ah, yes. That's a fascinating piece of evidence. Closed-end funds own a basket of stocks, right? And normally, historically, they trade at a discount to the actual market value of the stocks they hold. Maybe 10, 20% less?
Because of fees, or maybe they're harder to sell.
Exactly. But in 1929, from January to August, these funds traded at an average premium of 50%. Think about that. People were paying $1.50 for $1 worth of underlying stocks. Some funds were even wilder. Goldman Sachs Trading Corporation traded at twice its asset value. Tricontinental Corporation hit 256% of its value.
So you could buy AT&T stock directly, or pay 2.5 times as much to own it through this fund.
Precisely. That's not rational investing. That is pure, unadulterated speculative fever. Buying simply because you think the price will go higher, ignoring the fundamentals completely. Clear evidence of irrationality.
Looking back at all this, Tulip Mania, the South Sea Bubble, the 1929 crash, what's the big takeaway for listeners today? It feels like these things just keep happening in different forms.
They really do. Bernard Baruch, the famous investor, said studying this history is crucial for market survival, and he was right. Making money in markets isn't necessarily the hardest part, believe it or not. The real challenge is resisting that powerful temptation, that lure of the quick buck during speculative booms. It looks so easy, so tempting.
Siren song.
That's a good way to put it. It's a lesson history teaches again and again, but each new generation seems determined to ignore it.
So maybe the final thought for everyone listening is this. As you navigate the markets today, with all the noise and excitement around certain trends or assets, how do you spot when you might be starting to build your own castle in the air? How do you resist that pull, especially when everyone else seems to be caught up in it, and stick to a more grounded long-term view? Something to definitely think about. We genuinely love to hear your thoughts on this. Jump into the comments section and let us know what resonated. Which type of wealth are you focusing on?
Yeah, let us know.
And hey, if you found this discussion useful, maybe learned something new, definitely hit that subscribe button. We do these deep dives regularly, exploring valuable ideas.
We appreciate you tuning in.
Yeah, thanks for joining us.